According to the Social Security Administration, if you claim benefits at 62 instead of waiting until full retirement age, your monthly check can be permanently reduced by up to 30%. That reduction lasts for life, but that's not the real trap. The real trap starts earlier, at 61, and almost nobody sees it. Most retirement ages get attention. 59.5, penalty-free withdrawals. 62, Social Security eligibility. 65, Medicare. 73, required minimum distributions. But 61? No headlines, no letters, no required action, which is exactly why it's dangerous, because 61 is often the last year you have full structural control over your tax strategy before multiple systems start stacking on top of each other. Here's what happens quietly. Under current IRS rules, required minimum distributions begin at 73. Those withdrawals are mandatory and taxed as ordinary income. If you retire around 60 or 61 with a large traditional IRA and simply let it grow, that balance can compound for more than a decade. Then, at 73, the government decides how much you must withdraw. Not how much you want, how much you must. That required income stacks on top of Social Security, investment income, capital gains. And here's where it tightens further. The income thresholds that determine whether up to 85% of your Social Security benefits are taxable have never been indexed for inflation. They've been fixed since the 1980s. Each year, more retirees get pulled into higher taxation, even if their purchasing power hasn't meaningfully changed. It doesn't feel dramatic. It feels gradual, until you run the math. Imagine retiring at 61 with $2 to $3 million, most of it in traditional retirement accounts. You delay Social Security, you avoid touching the IRA, you assume you'll be in a lower bracket later. By the time you hit 73, the IRA is larger. RMDs begin. Social Security is active. Your taxable income is now higher than it was at 62, and the lower bracket in retirement assumption collapses. The window that could have reduced the long-term tax hit, your early 60s, is gone. Here's why 61 matters structurally. First, Social Security hasn't entered the equation yet. Once you hit 62, even modeling benefits starts influencing tax strategy decisions. Second, Medicare uses a 2-year lookback to determine Part B and Part D premiums. Income at 63 affects premiums at 65. Income at 64 affects premiums at 66. Large income spikes after that point can trigger years of higher premiums. At 61, that lookback clock hasn't started. Third, the years between retirement and RMD age are often your lowest taxable years in retirement, if you plan intentionally. If you don't, they become wasted opportunity. This isn't about panic, it's about math. A modest 8 to 10% difference in marginal tax exposure applied to 6-figure annual withdrawals over 20 years can translate into 6 figures of lifetime impact. Not because markets failed, because timing was ignored. 3 moves typically deserve evaluation before 62. Strategic Roth conversions while income is temporarily low, capital gains harvesting if you fall within favorable brackets, and coordinated Social Security timing that considers tax stacking, not just benefit size. None of these are automatic. All of them become harder once Social Security, Medicare lookbacks, and future RMDs begin interacting. Most people won't act at 61 because nothing forces them to. There's no penalty notice, no eligibility deadline, no required withdrawal. It feels like just another birthday. But structurally, it's the last clean year before the system's formulas begin running together. And once they do, flexibility shrinks, gradually, quietly, mathematically. If you're approaching 60, the question isn't whether you'll pay taxes in retirement, it's whether you'll pay them on your terms or the system's. If you found this video helpful, hit the like button and subscribe so you don't miss future updates. Now, just remember, after 61, the leverage starts shifting, and that's where you have to pay attention. And unfortunately, it doesn't shift back. Just stay informed and keep up with any new changes, if any. You've got this. Thanks for watching.